property owners around the world were trained to believe one simple idea: real estate only goes up. Cheap money, low interest rates, and easy credit created a sense of comfort that slowly turned into blind confidence. Homes were no longer evaluated as financial instruments, but as emotional trophies. People stopped asking whether a property made financial sense and instead focused on how it made them feel. As we move toward 2026, that illusion is beginning to crack. The economic environment has changed, and the rules that protected careless decision-making no longer exist. Interest rates are higher, credit is tighter, and capital is no longer free. This shift alone is enough to rewrite the future of property values. The most dangerous part of this transition is that many homeowners still believe they are safe simply because prices have risen in the past. They assume appreciation is guaranteed, ignoring the fact that prices are ultimately limited by income, affordability, and borrowing costs. When the cost of money rises faster than wages, the math no longer supports rising prices. This is not a theory, it is a financial law. Every asset must eventually justify its price through cash flow or utility. When it fails to do so, a correction becomes inevitable. As capital becomes more expensive, buyers lose purchasing power. A home that seemed affordable at low interest rates suddenly becomes unreachable when borrowing costs double. This does not require a recession or a crisis. It is simply arithmetic. Fewer qualified buyers means weaker demand, and weak demand places pressure on prices. This is the environment we are entering. It is quiet, slow, and dangerous precisely because it does not arrive with panic at first. It arrives with denial. Many property owners still believe that time alone will solve the problem. They assume holding on long enough guarantees recovery. Time does not fix bad economics. If a property cannot support itself financially, the time only increases the cost of ownership through maintenance, taxes, and opportunity loss. The market does not reward patience when the underlying structure is broken. It rewards discipline, adaptability, and realism. This chapter sets the foundation for understanding what comes next. The real estate market is not collapsing because of fear or emotion. It is adjusting because mathematical reality has returned. The era of effortless appreciation is over, and a new phase has begun where only properties aligned with economic fundamentals will survive. Those who understand this early will protect their wealth. Those who ignore it will slowly watch it evaporate. One of the clearest warning signs in today's market is the growing gap between what a property costs to own and what it can earn. Many homeowners justify losses by telling themselves that appreciation will compensate for negative cash flow. This mindset confuses speculation with investing, and investment produces returns. Speculation relies on hope. When a property consistently costs more to maintain than it can generate in rent or economic utility, it is no longer an asset. It becomes a financial liability disguised as ownership. True investors evaluate property based on return, not emotion. They ask whether the income generated justifies the capital. Invested metrics like capitalization rate and debt service coverage are not academic concepts. They are survival tools. When the income from a property cannot comfortably cover its financing costs, taxes, insurance, and maintenance, the owner is effectively paying for the privilege of ownership. This model only works when prices rise rapidly. In a high-rate environment, it collapses. As we approach 2026, many properties will face this exact problem. Mortgage rates have risen, but rents have not increased at the same pace. This creates a negative yield situation where holding the property produces guaranteed losses. Over time, these losses compound. Meanwhile, alternative investments, such as dividend-paying equities or bonds, begin to look increasingly attractive because they provide income without operational risk. Another critical factor is affordability. Property prices must eventually reflect what local residents can afford to pay. When prices rise far beyond local incomes, the market becomes fragile. Investors disappear first, followed by owner-occupiers who can no longer qualify for financing. At that point, sellers compete for a shrinking pool of buyers, and prices adjust downward. This is not a moral judgment on homeownership. It is a financial assessment. A home can be a place to live and still be a poor investment. The mistake occurs when people confuse shelter with wealth creation in the next phase of the market. Properties that cannot justify their price through income or utility will be repriced. Recognizing this early allows owners to make rational decisions instead of emotional ones. Many property owners focus intensely on their individual home while ignoring the economic ecosystem around it. Real estate does not exist in isolation. Its value is directly linked to local employment, business activity, population growth, and tax stability. When these factors weaken, property values eventually follow. The danger lies in how slowly this process unfolds, allowing denial to persist long after warning signs appear. Job migration is one of the most powerful indicators of future property performance. When high-paying employers leave a region, they take purchasing power with them. Fewer well-paid workers means fewer qualified buyers. It leads to longer selling times, price reductions, and eventually forced sales. Many homeowners dismiss early signs, assuming new businesses will replace the old ones. Sometimes they do, often they do not. Tax policy also plays a major role. Regions that increase taxes to compensate for declining commercial revenue place additional pressure on homeowners. Higher taxes reduce affordability and discourage new buyers. Over time, this creates a negative feedback loop where falling values and rising costs coexist. This combination is particularly destructive because it traps owners between declining equity and increasing expenses. Smart capital moves before conditions deteriorate fully. It follows opportunity, not nostalgia. Investors who understand this pay attention to where businesses are expanding, where infrastructure is being built, and where population growth is sustainable. They are willing to exit emotionally attractive locations if the economic data no longer supports ownership. As 2026 approaches, the gap between thriving regions and declining ones will widen. Property values will increasingly reflect economic reality rather than past reputation. Owners who understand this can reposition their capital. Those who ignore it risk holding assets in areas where demand quietly disappears. Debt amplifies outcomes. In favorable conditions, it accelerates gains. In unfavorable conditions, it magnifies losses. Many property owners underestimated this reality. During years of low interest rates, adjustable loans, short-term financing, and aggressive leverage were treated as harmless tools. As rates rise, these decisions are being exposed as dangerous liabilities. Resets represent one of the greatest risks in the coming years. Payments that once seemed manageable can increase dramatically, placing immediate strain on household finances. Owners without sufficient income buffers or fixed-rate protection may be forced to sell under pressure. When many owners face this situation simultaneously, supply increases while demand remains weak, pushing prices lower. Renovation decisions also deserve scrutiny. Not all upgrades create value. Aesthetic improvements often provide emotional satisfaction but little financial return. Over-improving a property in a declining or stagnant market can trap capital that cannot be recovered. Functional improvements that protect the structure and reduce operating costs matter far more than luxury finishes during economic tightening. Another overlooked factor is maintenance burden. Properties with high ongoing costs become increasingly unattractive as consumers prioritize efficiency. In a constrained economy, buyers and renters favor practicality over extravagance. Homes that require constant spending to maintain perceived value lose appeal quickly. Understanding these dynamics allows owners to separate sunk costs from future decisions. Past spending should not dictate future strategy. What matters is whether the property can perform under realistic economic assumptions. If it cannot, preserving capital may require difficult but necessary action. Periods of economic transition create both destruction and opportunity. The difference lies in preparation. Those who understand the risks can reduce exposure, strengthen balance sheets, and wait for better conditions. Those who remain emotionally attached to outdated assumptions often become forced participants in the downturn. Years will reward liquidity, flexibility, and discipline. Investors who maintain low leverage, strong cash flow, and diversified income streams will be positioned to act when others cannot. Distressed assets eventually appear, but only those with capital and patience can take advantage of them. This is not a call for panic. It is a call for clarity. Auditing property performance, understanding local economic trends, and evaluating debt structures are not optional tasks anymore. They are essential. Ignoring these realities does not prevent consequences. It merely delays them. Wealth preservation begins with honesty. The market does not care about intentions, effort, or memories. It responds to numbers. Those who respect this truth will adapt. Those who resist it will struggle. As we move toward 2026, the real estate market will not be kind to complacency, but it will reward those who act with intelligence and courage. The future belongs to those who treat real estate as a financial instrument, not an emotional anchor. Understand the math, manage risk, and stay patient. That is how wealth is protected, and that is how the next generation of opportunity is built.